Okay, so let's take a look at the next example. We have a 75% parent and a 25% NCI. We'll deal with the NCI in a moment. So the question says, the subsidiary sells inventory to the parent for £2,200 at a markup of 10%. And the parent has sold 50% of this inventory by year end. Slightly different arrangement to previously. Let's just take a quick look at the profit. Just be aware here that the question is slightly different from the last one. It's given a markup amount rather than a margin amount. That's the calculation for markup. The sale cost or the sale price equals the cost of goods plus the markup. So we can put some figures in here. We could call the cost 100% of the cost, and the markup is 10% of the cost. So in total, that's 10 out of 110%. And the cost would be representing 100 out of 110. So in total, there the sale cost or the sale price is 2,200. The cost is 100 over 110 of the total, and the markup is 10 over 110 of the total. And as we want the profit figure, we can just go straight to it. It's 2,200 times the markup amount, which is 10 over 110. And that will give us the markup for the whole transaction. And we can do that here. Plus 2,200 times 10 over 110 gives us a figure of, just open that up slightly, of £200 for the total. Now that's the total profit for the entire transactions between the parent and the subsidiary, and we know that the parents only sold 50%. So the profit realized of 200, 50% of that is going to remain unrealized at the end of the year. So it shouldn't take rocket science to tell us what that amount is going to be. 50% of 200 means there's £100 unrealized profit. Okay, so we can just put these figures straight in. Let's see. So who was the selling and who was the purchasing entity? The subsidiary sells the inventory, so their revenue is overstated. So we need to reduce their revenue by 2,200. And the parent entity purchased these products, purchased this inventory, and has their cost of sales overstated, so that needs to be reduced by negative, or reduced by 2,200. And like before, the selling entity has to reduce their profit by this unrealized profit amount, and we do that by just increasing their cost of sales by that amount. £100 there. The subsidiary sold to the parent, so the subsidiary's cost of sales is increased by this unrealized amount. And then that's all the adjustments done. So let's just add all these up. We just add them up right across. 25,000. Oops. 25 plus 12. Then add the negative 220 plus 10. Add the negative 220 again. add the 5, and then add the plus 100 adjustment for the unrealized profit. That gives us a profit of 21,900. So it's the revenue minus the cost of sales, 21,900. The dividend from the sub, we know we need to ignore this because we're going to, that's 1,000, we're going to ignore the 1,000 here. It's just a transaction between the two entities again. That gives us a profit before tax equal to that. The income tax expense is those two added together, P plus S. The dividend is the parent only, so it's funds going out of the business, out of the group. So that's 1,000. Now let's just ignore NCI for a moment. If there wasn't an NCI, let's put this profit after tax figure in. Profit before tax less the tax is 15,700. If there wasn't an NCI, it would just simply be this less this 14,700. However, there is an NCI, so the NCI is going to want their proportion of the profit after tax, which I will just put in here. 5,800. Okay, looks good. So what is the amount of profit that is due to the NCI? Is it 5,800 or 25% of that? Well, it's 25% of 5,800 less the unrealized profit of 100, or their share of that unrealized profit. So we're going to take this amount, we are going to reduce the profit by the unrealized profit, comes to that, and then multiply it by the NCI percent, which is 0.25, 0.25. Takes us to 1425 due to the NCI. Let's just go through that calculation again. Normally it would be the NCI's percentage of the subsidiary's profit, which is the standard 5,800, but we need to reduce that profit by the unrealized profit. And it's different this time because it's the subsidiary selling to the parent, so the subsidiary has made that profit. In the previous example it was the other way around, and we didn't need to make this adjustment. So profit minus the PUP times 25% for the NCI's share, 1425. In fact, let me just write that out in text. So it's 5,800 minus 100 times 25, the 25%. And then that will give us a calculation exactly the same, plus this. And we're going to reduce the profit we've made by this unrealized profit amount, and then multiply it by 25%. Comes to 14.25. Let's just expand that slightly. 25%. And of course we need to remove this from the retained earnings from the group. Gives us a total of 13.275. So this final figure is profit after tax minus the parent's dividend, money going out of the business, less the NCI's share of the subsidiary's profit including this adjustment for the PUP. Comes to 13,275. So slightly different than previously. The subsidiary doing the selling. So the subsidiary takes this adjustment, and because it's the subsidiary, the NCI wants a share, and their share needs to take this adjustment into account. So there we are. Let's put these in. I won't do all that. Let's just go through them like this. Add all these up. 25,000 plus 12 minus 220 comes to this. Add these all up together. The parent cost of sales, reduce it by the transaction amount, add the sub cost, and add the unrealized profits to the cost of sales to reduce the overall profit. Comes to a figure of 21,900. Ignore the dividend, add in the tax. That's the parent's only dividend going out of the business. This is the NCI amount, 25% of 5,800 profit after tax, which it's due. It's its share of the profit after tax, and it also has to reduce that amount by this adjustment. The cost of sales, which was unrealized, or the PUP rather, that was unrealized for the year. So you have to reduce that amount by the PUP. And there we are. So that is a consolidated statement of profit and loss with an NCI using markup, with the subsidiary making the sale this time. Again, just be careful who's making the sale. Is it the parent? Is it the subsidiary? And just be careful, is it the are we using markup or are we using margin? Calculations are just slightly different. There we go.